A very warm welcome to all our investors and partners in this special monthly Connect program of Canara Robeco. In this, we actually meet our investment team, and today it's my pleasure to introduce our Head of Equities, Mr. Shridatta, who is going to talk to us and share his perspectives on the economy, on the markets, and on the funds. So, welcome, Shri.
Good morning, Gaurav.
Thank you. Shri, let me just start with asking your perspectives in terms of when you look at globally, last 1 year, 2 years, we have seen in terms of excessive rate hikes. And of course, globally, we were debating about in terms of soft landing and hard landing. But when you look back now, the global markets are firing. So S&P 500 is at lifetime high. We have seen even now the Japanese Nikkei hitting the lifetime high. So what's happening? Can you just explain to all of us in terms of what's driving this global market right now?
So clearly, we're in an interesting phase, and based on the past experiences, when you always had this kind of interest rate environment, you have had an impact in terms of how it plays out in the economy. So a 300 basis point or 250 basis point interest rate increases, naturally the expectation was you will go into hard landing because it will cause significant damage to household balance sheets and corporate balance sheets. Okay. The one point that probably all of us missed and generally consensus missed, and which is coming to fore now, is that before this event happening, government had just put in, particularly in developed markets, so much of money in the hands of households, or in a way corporate balance sheets was so clean that the economy has been able to take this impact and not actually go to a stage which is hard landing where everybody was expecting. So predominant reason why we are not actually getting into hard landing is, while there is an incremental impact of interest rate increases and liquidity tightening that is happening on economy, it is just not happening at a pace at which everybody thought. And that is leading to a situation where it looks like, when you look at US hourly wage rate increases, which is a particular data point that I look at, you look at the unemployment rates, and then you look at basically earnings growth or GDP growth rates. The numbers are not actually showing you that we are getting to a stage where there is likely to be a very, very large recession or a sizable recession, and that's where market is getting comforted. That's where also you are seeing some of these developed markets, particularly US, the markets are hitting new highs. But when you actually look at US market hitting new highs, you also have to actually take into consideration that it is predominantly driven by a Magnificent Seven, which is the top 7 tech stocks. So it is predominantly a tech rally rather than a very, very broad-based rally. Having said that, yes, the numbers even in US in terms of broad-based earnings growth are not turning out to be as bad as that it was expected. Okay. And that is flowing into the market in terms of where the expectations were 6 months back and now where expectations are. Gradually market is rewarding that. Of course, a lot of people, it seems like they understood these things 6 months back, and that's why market has not corrected during this phase. So that's where we are. I think Japan is a different story. Finally, after 30-40 years, or 50 years, they're coming out of deflation. They're thinking about formally declaring that they are out of deflation, and which is a big thing, because for any economy to have a nominal GDP growth rate and have earnings growth rate, and for markets to do well, ultimately markets is a function of earnings, and earnings is a function of nominal GDP growth rate. And within the nominal GDP growth rate, the inflation part was completely missing for a very, very long period in there, and expectations were really running low. Now that equation seems to be getting sorted to some degree, not that they'll suddenly start growing at a very high pace, but the inflation is coming back. So for a mature economies, even a 1% inflation or 0.5% inflation can lead to earnings growth of 5%, which can seem like a very, very good earnings growth from where you came. And on top of that, I think the one thing that is happening in particularly Japan is they are actually resolving a lot of these holding company structures that they had, and that's where value unlocking is happening. Typically, when you have cross holdings, you get multiple discounts because there are a lot of holding company discounts that market applies to you. Then a lot of groups are actually resolving those structures, and that's where you are seeing some of those groups are actually getting re-rated significantly. And these are large, and Japan, Korea, predominantly basically large conglomerate market. So that's where you are. Having said this, so key takeaway for us from our perspective from all these global environment is 2 or 3 fold. One, particularly from US, Europe's perspective, since the US is not going in the moderation which was expected. For at the margin for IT or textiles or chemicals, eventually once the destocking is over, or once in sectors like IT, once the corporates realize that they are not going into as bad an environment as it was expected, say 6 months or a year back, probably at the margin there will be either first stage will be earnings downgrades will stop, and at some point in time individually companies who are in right kind of spaces, the earnings upgrades could be on card. So that's one takeaway for us. Second, it also means that the interest rate environment is likely to remain at a higher level for a relatively longer period. We're not going into basically effectively, we're not going to see cuts at least in first half clearly. Probably second half we'll see cuts. That too also, now with the kind of numbers that are coming in, it looks like you will have 1 or 2 cuts rather than 3-4 cuts which were earlier expected. So clearly is getting postponed, and it has its corollary in terms of one of the technical factors that most of the people are expecting, that the flows will start towards emerging market. At the margin, if it doesn't fall faster, the opportunity cost to move your money out of those markets is relatively high, particularly in US. Like, for example, today in US you are getting 4.5%, 5.5% in risk-free rate. So there is not enough push in terms of the cost of opportunity cost for you to go out of your country for a lot of investors. So I think that is getting delayed a little bit. And third is in terms of basically while some of these things at the margin are improving, if you take a top-down homogeneous view or a basically holistic view, you still have US which will relatively do well, but Europe which is struggling, Japan which anyways grow at almost 0% or 0.5%, and then you have China which is structurally slowing. So from a commodity price perspective, this should be a good environment for us as a country because we predominantly import virtually everything. So that's how we are looking at the global environment. Clearly it's not turning as bad as it was expected, but bad enough for commodities to remain low. So hopefully we'll be able to construct our infrastructure at a lower commodity cost.
Okay. I think, but it's an interesting perspective. What you're saying is higher for longer, considering the way the data is also coming from US. So I think, and that can have implications in terms of the FI flow expectations. Also, Shrib, when you look at in terms of the post-COVID world, one major change which has happened from an Indian perspective is the weight of India in the MSCI emerging index has actually moved from 8% to 18%. But when you look at in terms of the FI ownership here in India, is actually declining. So how do we understand this trend?
So it's clearly in terms of how we are placed within the emerging markets, we are likely to get more and more importance, and that's visible in the way MSCI India index weight is going up in the overall MSCI. So when you look at the emerging market pack, I think this trend is here to stay for some more time, clearly, because we will be among few large emerging markets which will keep growing at a higher pace than most of the other markets, and particularly you will be effectively gaining the MSCI weight from China. At some point in time, Korea might go out of MSCI, so you might further get leg up in that. So that's clearly happening as your growth rates actually outpace the other growth rates. Having said that, generally the long only guys in India have been significantly overweight. Emerging market funds, global funds have been overweight in India, and they have been overweight predominantly through two indices, IT and financials. Unfortunately, for last 2.5 years, while IT at the partly has done well, but in financials, which is the largest weight, probably 30-35% of index, and in there, as far as I remember, in the FIIs, it is like 40-45% of weight in their overall India allocation. It hasn't done as well, particularly where they were in the private financial space. And to that extent, you have seen the trimming of those weights, and that's where you see that you don't get the net inflows. So why? It's just the composition that is changing, but financials is something that people have significantly reduced weight, given that the financials they tend to own have underperformed over the last 2-3 years. So that's the only way to understand it, because if you look at last 3 years also, and predominantly last 2 years, net FI flows has been zero. You got basically $17 billion of outflow in calendar year 22. Calendar year 23, we have about $21 billion of inflows, and in last 2-3 months we would have some outflow. So net zero. Although calendar year 21 was a positive flow year, 20 and 21. Or 20 was also 0, 21 was positive. So when you look at that, it is more how financials, which is the largest weight in their basket, has played out. And I think the moment the earnings growth differential between private financials and the rest of the market starts narrowing, I hope that a lot of that money will also come back again. That's one way to look at it. Second is, if you actually look at it just from the pure earnings growth perspective, what has happened in last 1.5 years might have happened just because India is relatively quite more expensive as compared to the other markets. Second, probably outflows have been in most of the other emerging markets. But when you take the structural view and when you look at, is there any other large geography which can offer you diversified market participation with a capital efficiency of upwards of 15% ROE, ROC, and large privately owned businesses? I think India almost stand out there. So I have no doubt that was that valuation equation where if you actually talk to most of the FIs, the only worry that they have is India is relatively more expensive as compared to other. So they want to come in, but valuation is a barrier. So as market consolidates, as that space where they have largest weight, which is financials, actually there the earnings growth actually on a relative basis start playing out. I think the flows will also come back. So that's how we are looking at it. From a structural perspective, if you look at India, one, on growth and capital efficiency, you fare better as compared to most of the other emerging markets. And second, and this is just my personal view, don't hold me for this. One of the other factor which in emerging markets which impacts the developed market investors is the currency depreciation, because it works against you. I think that is a passe gradually for India. As you evolve to a 3,000, 5,000 per capita economy, we are already at $2,800. You are actually fixing in your supply side. Once you fix your supply side, your structural inflation will go down, which means the inflation differential will go down. So your currency will have less bounce of every year of on average 5-7% depreciation. If that is not there, then your returns in dollar term and rupee term can become far more closer. That will also actually drive a lot of people to come in as time passes. Growth and the lack of risk on losing out on currency side.
Sure. Okay, Shri, so let's talk about the Indian economy now. The Q3 GDP numbers at 8.4, does it surprise you?
It does in terms of the absolute number, but if you actually get into the numbers, its GVA is about 6.5%. So it is trending around 6.5-7% rather than 8.5%. And the differential between the GDP growth rate and GVA is higher net tax collection that you had on the indirect side and less of subsidy. That's what it explains it. So core you can assume that you are basically as an economy, although it's a healthy number, but you are actually more closer to 7 than 8.5%, which is a headline number, because that will actually the difference between indirect taxes and the GDP will start correcting. So GVA and GDP will actually start trending closer to each other. So we are actually not reading too much into it. We're just actually looking at the factor that it is still holding at around, on an average at around 7%, which is a very, very healthy number.
Correct. And fact of the matter is that it's one of the fastest
growing, one of the fastest,
economy.
In fact, the fastest growing economy now.
Coming back to the markets, now of course the last 1 year the Indian markets has been on roll. So when you look at the Nifty 50, it's 28%, Nifty mid cap is 57%, Nifty small cap is 68. When I look at Nifty micro cap, it is actually doubled, 96% to be precise. When you look at some of the other indicators like the Buffett indicator, which he tracks is market cap to GDP, it's above than the long-term average. So the way the returns have happened in the last 1 year and now, from a next financial year perspective, how do you see these returns profile across the market caps?
Sure. So returns in themselves don't tell you anything about what is happened in short term, because we are debating 1 year returns. You have to look at what is happening to earnings, and are earnings actually panning out well. So if you take a 4-year view or 5-year view from 19 to 24, our earnings virtually have doubled for even Nifty. You don't get a lot of numbers, but BSE 100 and Nifty have clearly doubled. Correct. So, and to that extent, market has doubled at Nifty level. The challenge is as you go down, while the earnings have also doubled, some of these spaces have quadrupled. become 5 times, 7 times. And that's where there is a little bit of upfronting of the valuation multiples that has happened. So the focus has to be on earnings, incrementally how earnings play out. Yes, some of these businesses, as you go in broader market, were really cheap to start with in 2021, so they have re-rated. But in terms of the ability of earnings to keep pace versus the valuation multiple upfronting, it looks to us that basically clearly there is a lot of upfronting of valuation multiple that has happened as you go down below 200, top 200 companies, where research is broader market, where research is not very easily available. Either one analyst is covering it or nobody is covering it. So that's where the predominant challenge of what earnings delivery can happen and what expectation is, that's where there is a gap in our view. Clearly it is reflecting in the valuation multiple also. As you go into mid cap and small cap, they are trading at about 20-25%, 30% premium to large cap today, which has happened only probably 3 or 4 times in last 20 years. Okay, and that tells you that not that it can't continue, but for that to continue, your earnings delivery in the broader market has to be far superior. And that's where probably lately market has taken a pause, and that was also our view for last 3-4 months, that when you look at the earnings that have come in for the third quarter, in terms of hits to misses, there are a lot more misses in terms of internals of the number or actual numbers, while the aggregate numbers were still very healthy. In terms of earnings growth. Say for Nifty, the earnings growth was about 20-22%, 20%, around 20%. For the broader market, the earnings growth was about 23-24%. But the key was what was market expecting and how those numbers played out. Clearly there were more misses in the broader market than hits. One. Second is also it is not driven by the top line growth. For sustainability of earnings growth, it has to be driven by the volume growth, which means the demand is very strong, and that's where you are getting operating leverage and your earnings are very strong. A lot of these 25% earnings that you are seeing in last quarter or even higher than that for first 9 months is significantly driven by the margin expansion that happened on a YOY basis. Now you can't assume that is a normalized case. You are not going to get margin expansion next year, and that's where our view is that as you go into next year, while structurally there is nothing wrong, but the earnings growth will still be fairly moderate as compared to what you saw in financial year 24. So in financial year 24, you will have Nifty earnings growth of 24-25%, and you will have broader market earnings growth of anywhere between 29 to 32%, depending on what part of the market you are looking at. When you look at financial year 25, you will have probably 13 to 16% earnings growth, whether you are looking at large cap, mid cap, small cap, and that's where the earnings convergence as well as the disproportionate earnings growth that showed up in 24 because of the margin expansion is unlikely to be there. And that's where our view is also that probably given that large caps or larger mid caps of flexi cap kind of categories which have underperformed, where the valuation is in line with broadly in line with historical valuation or at 5-10% premium to historical valuation, that's the part of the market where from at least 1 year's perspective your risk reward looks like far better. You also have to put these things in the context when you actually look at market, when the market is rallying or when market is in depression, people tend to focus too much on stock prices. But if you look at last 2 years, 3 years, calendar year 22, the market didn't give any return, because in financial year 23 the Nifty earnings growth was 9% and mid cap small cap earnings growth was some 4-5%. Okay, so ultimately market is slave of earnings. In 24 earnings came, market did really well. In 25 earnings are likely to be more moderate, so market is likely to more get into a phase where you will get rollover return if your portfolio is good. If your portfolio is probably consists of weaker businesses, you might not even get that. So that's how we are looking at it, predominantly based on how earnings are playing out. So that's the contextual view of market as to what is likely to happen for 1 year. A lot of investors will say, oh, I'm not interested in what is likely to happen in 1 year, but what is your structural view? Structurally, we still remain extremely constructive on Indian market, and the predominant reason for that has been that, and which we have repeated in almost virtually every conversation that we have with investors, is that when in particular economy is a balance sheet expansion zone, you don't get recessions or you don't get significant capital erosion in markets also, because your earnings will keep playing out. Earnings might not play out at 30%, but earnings will keep playing out at 15%, and which is a very healthy earnings growth. So when we look at the balance sheets of the corporates, we look at the balance sheets of the banks, we look at the government's intent to focus on the capex part of the economy rather than the revenue expenditure part of the economy. And when you look at household who has already gotten into capex cycle, and for household the capex cycle is real estate, which is very, very visible in the way real estate is playing out, although it is not broad based. So all four key stakeholders are focused on actually expanding the balance sheet. And in that phase, typically you won't get earnings recession. And if you don't get earnings recession, you will not have structural challenges. You will have tactical challenges based on, or contextual challenges based on what you did last year, but you will have a structural runway for earnings growth. And that's where we feel that 15% earnings growth for next 2-3 years is almost given, because in real estate you are at the start of the cycle, in private capex you are at the start of the cycle, the public capex is happening, the government is actually driving policies which are encouraging the investment part of the economy, and you have household which had just started the real estate. And this has happened after, if you look at, after a very, very large gap between 14 to 20, you had basically balance sheet recession.
Okay.
So you got earnings recession also. Now you are in a balance sheet reflation, you will get earnings reflation also. That's how we are looking at it from a structural perspective.
Yeah, absolutely, you're right. And I think that is also reflecting in terms of the positive is the bank balance sheets are also much more stronger, cleaner.
Extremely clean.
And you are looking at, that's how the credit growth is also happening, which is higher than the deposit growth rate in the industry. So which is talking about that. Yeah. Also, given your views in terms of the market caps, could you also elaborate us and share your perspectives on which sectors which are the pockets in the market that you see the earning growth, and of course then in your portfolios where you are overweight and underweight?
Sure. So you would have by now guessed that based on the view that we have, that we are in a balance sheet reflation, domestic cyclicals is collectively is where still the portfolio is overweight on. Okay. There are also other sectors, but let me go through them broadly one by one. Financials is neutral to overweight, although financials will have a little bit of challenges in financial year 25. I think a lot of private financials which were underperforming till now, their earnings recession or relative earnings underperformance which reflected in stock prices is largely over. So their earnings will be no more inferior to the public sector banks or the other parts of the financial services. So that part continues to be overweight.
Okay.
Generally, financials as a sector neutral to overweight, because it's part of domestic cyclical. We don't think credit growth cycle is over. You're likely to have 12-13% credit growth for another 2 to 3 years at least. So that's not over. So that's one space. Second is industrials. Again, while in industrials there has been a little bit of upfronting, there has been a little bit of more exuberance in near term, but that's one space where the cycle has come back after 10 years. We don't think that cycle is likely to break in 1 year or 2 years. We are not yet seeing the private capex in a big manner. While we are seeing it in a nuanced manner, you have only seen the public capex, you are not seeing the private capex. Okay. Our sense is for next 2-3 years, you will see private capex happening more and more. So that still remains overweight. Third is basically consumer discretionary, where part of it had challenges, but when you look at the auto and select industrials, select consumer discretionary retail names, they are doing extremely well. So that's where the portfolio remains overweight. Within auto, of course, PVs and two-wheelers is where the portfolios are tilted, not so much on CVs. Then you have basically real estate, then you have cement, again cyclicals. These are the domestic cyclical spaces: financials, consumer discretionary, industrials, cement, and real estate. Then hotels, which is again domestic cyclical. So these are the domestic cyclicals. Then when you come to basically non-discretionary or defensive sectors, basically you have domestic pharma, hospitals, telecom. These are the three spaces, and selectively FMCG. These are the four spaces which are non-cyclical, but predominantly domestic, which is where again the portfolios are overweight on. Overall, in FMCG, of course, we are underweight, but selectively some pockets we are overweight in FMCG also. So that's how the overweights are. On underweight side, still IT, while the earnings risk are reducing. Although till last quarter you had earnings downgrade, I don't think even this quarter you will get earnings upgrade. Even this quarter you might get earnings downgrade. But it looks like what they do is a function of, on a forward basis, what is happening in predominantly in US Fortune 500 companies. And for Fortune 500 companies, if outlook at the margin is looking better for their earnings, at least the downgrade cycle seems to be over. So we have over last 3 months, 4 months, we have at the margin added the large IT companies, but still underweight on a net basis. FMCG remains underweight. Commodities and energy, while in market it has done well, for us it remains underweight because as a thought process also, we find it very difficult to buy a lot of them because there are hardly any structural stories there. So a lot of excitement about what is happening in quarterly numbers or what is happening in near-term numbers. But even when you look at 3-year number, you can't actually, with a very high confidence, talk about how they are likely to play out. And to that extent, that part of the economy or that part of the market still remains underweight in the portfolio. So that's how the portfolios are positioned broadly.
I think this is really helpful.
And earnings. This is how we are expecting earnings likely to play out.
Okay,
that wherever the earnings are likely to be either neutralish to positive, that's where the portfolios are also overweight.
Okay. Thank you so much, Shridatta. I think we had talked about the global markets, you have given us your perspectives on the Indian markets, and of course, in terms of how you are overweight and underweight in your portfolios. I'm sure definitely this conversation is really helpful to all our partners and investors. Thank you very much.
Thank you, Gaurav.
Thank you to all our partners and investors for joining us on our monthly Connect program at Canara Robeco, and we'll connect soon in our next session. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.